What is life insurance? What is life insurance? After completing this module, you will be able to describe and understand the components of insurable risk, the fundamental structure of a life insurance policy and its typical policy provisions, and the concept of a life or lives insured and of an insurable interest. Policy movements and specifically the concepts of surrender value, a paid-up policy and a policy loan. The nature, uses and limitations of both mortality and morbidity tables. Insurable risks. We all face risks in life which can result in economic loss both for ourselves and for our dependents. Life insurance is about meeting the financial needs that arise from these losses. In life insurance, insurable risks fall into three categories: the risk of poor health, the risk of death, and the risk of longevity. The life insurance policy. A life policy is a contract between an insurance company and an individual or group. In return for the payment of premiums, the life insurance company will pay a sum of money which is in some way dependent on the life expectancy of a person or a number of people. The contract describes the kind of protection that the life insurance company promises to give, and it states the rights of the policyholder. Terms are guaranteed long-term, usually between 5 and 50 years, and the contract cannot be amended or cancelled by the company unless specified in the policy document. The sum payable under a life policy is called the sum insured, and this becomes payable either upon the death of the life insured or their survival to the end of an agreed period. Profit participation. As we have already seen, in life insurance, insurable risks fall into three categories: the risk of poor health, the risk of premature death, and the risk of longevity. The products which cover these risks can be similarly subdivided: disability insurance, mortality risk insurance, and annuities. Mortality/morbidity tables. Before turning to the products themselves, we will briefly consider the key role played in all forms of life insurance by mortality and morbidity tables. It's important to get an idea of mortality and morbidity tables before studying the other modules in this program, because so much of life insurance is about estimating the likelihood of death or illness occurring. Of course, insurance companies can't predict when someone's going to die, but they can predict general mortality rates. Mortality tables tell insurers the rates at which insured people are expected to die. They are based on life insurance companies' historical statistics on the people they have insured.